Yeah, thanks everybody for joining today. We're super excited to go through this. This has been the top of the news cycle for all people in the ETA community in the last 2 weeks, really, since the new guidelines dropped. Lots of changes. Some of them we think are positive, other ones we're going to make it a little bit harder for buyers to go through the process of buying a business. And we're really excited to just break it all down and chat through it today. So, Thais, want to go to the next slide and we kind of
Yep.
introduce.
Yep, for sure. Sorry, getting a little trigger happy. Let me go to the next slide here. Okay. So background on myself. So I run a commercial loan brokerage firm called Pioneer Capital Advisory. I'm based in the Madison, Wisconsin area. My team currently consists of 9 people. So we help business buyers all across the country go through the SBA financing process. In the last 4 years and 3 months since we've started, we have worked with over 150 buyers on closing over 340 million of acquisitions. So this number on the second point here is admittedly not fully up to date. And recently, we've also started a non SBA vertical too. So people that are buying companies where the earnings profile is too big to get done with an SBA loan, that's a vertical or business area that we're also able to help with as well. And on the SBA side of our business, we get paid only by the bank and only after closing. And so there's no cost to the buyer to work with us since we're bank paid with a referral fee versus buyer paid. Chris, I'll flip it to you to give your background here.
Yes, my name is Chris Barrett. I own and operate Midwest CPA. We're a CPA firm specialized in working with acquisition entrepreneurs. We worked on a few hundred transactions in the last few years for quality of earnings analysis. And then we do support a lot of those clients post close on their ongoing outsourced accounting and tax needs. We're a team of about 22 people, and we're a remote firm, but I'm based here in Wisconsin. So
Awesome. Awesome. So just, yeah, Kev, more texture on us. And apologies if this is a little bit redundant from the prior slide. So we're a national focused commercial loan brokerage firm, focused on both helping buyers go through the SBA financing process, as well as independent sponsors and non-SBA buyers going through non-SBA process. We currently, on the SBA side specifically, we work with both buyers working on first time or initial acquisitions, current business owners that are doing expansion acquisitions, and then also debt refinances as well. So if you're a business owner and you have a loan on the balance sheet from when you bought your company, we can help you with navigating the refinancing process with that as well. And we partner and work with all different firms in this space that are kind of in the same atmosphere, from quality of earnings providers, folks like Chris, to different M&A attorneys, in insurance brokers, life insurance agents. And so we're not just kind of helping on the lending side from finding the financing. We also kind of help quarterback assembling the deal team and can give you as our client or prospect strategic recommendations on which different people work really well in this space to save you the time with having to go out to Google to find them on your own. So that's just some more texture on us. Chris, back to you here.
yeah, I think I ran through most of this already, so we can just keep going. Next slide.
Okay, cool. So, Kev, run down the agenda here and just various aspects of what we're going to cover in this webinar. So the first thing is, why is 8.1 substantially different? So why is this new SBA guidelines very different from the old one? And there's major changes that we're going to go through in detail. So we're also going to kind of hit on some of these other things. So talking about the different variables that impact debt service coverage, equity, and diligence. Chris is going to talk about the new guidelines with quality of earnings reports, since that fits squarely into his wheelhouse. I'm going to talk about down payment requirements and what is going to be changing effective as of October 1. And then we're going to talk about things changing with debt service coverage requirements, loan term and amortization if you're buying a business with real estate, and the elimination of the 51% rule. And then we're also going to talk about changes specific to how long your seller can stay on post acquisition with the new guidelines versus the old guidelines. And then some other things too, as far as eligibility to refinance out a seller's note that was used to purchase a business. So kicking off here, okay, first thing is this new guideline, the most recent SBA SOP that goes into place October 1st, is more than just a technical update. So this is from my perspective, and Chris, I don't want to put words in your mouth, but from mine, it's a substantial overhaul of the program, just with some of these changes. And essentially, the SBA is raising the floor of buyer financial avatar and making it kind of substantially different with the paradigm of things like quality of earnings reports and different. So with the new SBA guidelines change here, there are 4 different ways to classify a transaction structure. So one is an initial acquisition. What that basically means is that you're an external business buyer, searcher, first-time buyer that does not currently own a business that's acquiring one. There's what's called a business expansion, which is you're currently a strategic buyer acquiring a company in the same industry. Owner buyout is essentially you're buying part of a business but not all of it. And then there's an ESOP deal, which is basically employees buying out the company that they currently work for. And so we're going to go into each of these things. One of the biggest changes is on debt service coverage. So with the rising default rates in the SBA space, the SBA has taken note essentially that the floor of what has been required is the bare minimum. 1.15 was not sufficient. And so now it's being increased to 1.25 historical. So before with the 1.15, banks could look out at projections and they could theoretically base their debt service coverage on projections. Most banks that we work with at Pioneer did not and do not, but that was something that they had flexibility on. Now it's 1.25 historical bare minimum, and that needs to be validated based on historical financials, and for a deal over $3 million, it needs to be based off the quality of earnings report. Last thing here on this slide specifically is if you're buying a business as a complete acquisition, the seller can now stay on for 2 years versus 1 year. So before, basically, it was 1 year. This, depending on the type of company you're buying and how involved the seller currently is in your plans or in the transition, this can be a win. But depending on if you want the transition to only be several months, it might not make much of a difference. And then we're also going to kind of hit on some of the guideline changes specific to seller note refinances.
Matthias, I'm curious to
Yeah.
get your thoughts, like high level from this. Like, obviously, it's a big change. Like, why do you think the SBA has made this shift in the SOP? Like, what's the
Yeah.
goal here that they're trying to accomplish by making these big shifts?
Yeah. So this is just kind of me speculating, Chris. So on the 2 years with the 1 year versus so with the seller transition with going from 1 year to 2 years, I think depending on the type of business someone's buying, let's say it's something super technical, there's some tribal knowledge in just very industry specific things that just take time to learn. And based on the business that you're buying and like what that may be, and or if they're very important vendor relationships, customer relationships, and similar, some businesses 12 months or a year is just not going to be enough to hand off the baton there. And so I think, and this is just pure speculation, Chris, the SBA wants the person that's buying the business to be the one kind of in the cockpit or the driver's seat, pick your analogy. But I think they realized there that depending on specific types of businesses, a year just was not enough. And that was the rationale with rotating it to 2 years. That's just pure speculation. On the debt service coverage, I think if you look back to when both of us started our businesses, where prime was a lot lower at that point in time, and then interest rates jumped, I think basically the SBA wants buyers to have some shock absorber to factor in for the J curve and just surprises that come up after closing. And basically, I would presume that deals that got done at lower debt service coverage ratios where the buyer was not able to grow the business ahead of rates increasing and things of that nature, those deals just did not end up working out as well. And so that's kind of my thought process there. Now, as far as some of the other stuff that we're going to get to further along in this presentation, like talking about the 51% rule with real estate and that going away, I'm honestly not sure what drove those changes.
Good.
But so so this slide here, and Chris, kind of curious to get your thoughts. So basically, on an initial acquisition, this is so what changed here is the old debt service coverage requirement was that you only had to have 1.15 debt coverage to buy a business, and that could be based on historical or projection. And so now that's changed to 1.25. And so essentially the underwriting bar has gone up a little bit, which I personally think is a good thing for a first time acquisition. What are your thoughts, Chris, on like deals that you've worked on where you typically see
Yeah.
them clocking in from debt coverage?
I think this is a great one. And honestly, I don't think this will change very many deals for people. From most of the deals that I see getting done and the banks that we see clients working with,
Yeah.
most of them are wanting at least 1.25
Yeah.
already. So this seems to be just like the SOP catching up with what most banks were already
Yeah.
doing and enacting anyway. So
Yeah.
honestly, I don't see this shifting around too many deals or making it much harder. And I think it's a good thing
Yeah.
in general. I like this rule.
I'm a fan of this one because I think at the end of the day, like having some bumpers, if you will, in the program and some paternalism, you give people that are taking more risky bets just some additional margin that they wouldn't otherwise have taken. And so I think net net, this hopefully should set more people up for success versus failure. The second one here on business expansion and the minimum debt service coverage being 1.15. So what I find is specifically interesting on this guideline change is the old guideline when it came to expansion acquisitions is that you had to, so there didn't used to be this 2 full fiscal years under current ownership before you could do 100% financing. It was very lender dependent. So there were some banks I've worked with where if a buyer had run a business for 2 or 3 financial quarters and things had gone well financially, they would be open to financing the add-on. But the other thing was up until September of last year, it had to be the same ownership group, so same individuals, same geography, and the same 6-digit NAICS code. I think on this, it allows buyers to be a little bit more opportunistic on what they want to do for an add-on acquisition with the 100% financing because the same 6-digit NAICS numbers don't have to match. It's only the 4 digits. And so it gives you a little bit more of opportunism with what you want to acquire. Now, what I don't like with the expansion acquisition changes specifically is they've done away with the ability to do 100% financing with permanent working capital. And so if you're looking to buy another business in the same industry, if you want working capital, you either have to self-supply it or get it included in the purchase price of the business. What are your thoughts there from a high level?
Yeah, I think again, it's pretty typical for what I've been seeing. Like most of these requirements around this DSCR, I think a lot of times it's what the deals that I saw getting done or the requirements you're seeing from banks anyway. So I'm not sure that it's going to change too much. And I think they're just trying to protect everyone involved. And ultimately, I think the reason a lot of these changes were made is because there were a lot of defaults, and they're just trying to tighten up to keep people from getting to when the tide goes out. Right, get to see you swimming naked. So we're
Sure.
trying to protect people. One question we did have come in on this that I think is a good question is when they're calculating this DSCR, what period are they looking for? Or can you do TTM, or are they needing last tax return? Are they needing last few tax returns?
Yeah.
What's your understanding from the SOP on what period of time is needed for the DSCR math?
I need to double check because I don't want to say the wrong thing. I think potentially TTM could work. That all being said, generally speaking, most banks really want to see it based off the last year of a filed return. It's
Mm-hmm.
not that's not like a program requirement, but that's generally what I've seen.
Great. For the
It looks like
next,
there's another question. Is equity rollover still an option for expansion? So on the expansion, so Chris, answering the question on the equity roll, You can still now do a rollover seller equity deal, but if you're an external buyer, you can't take majority control of the business. If I remember, because I was reading this last night, and like when we get to the Q&A section, I'll pull up the SOP and I'll try to find the exact provision just to validate. All right, Chris, I might have you take this next slide here. If you like have run through this one here.
I think we hit this in the last one.
Okay,
Let's go. I think we got Q of E coming up on the one after
cool.
that.
Yeah, so business expansion, I'll just kind of hammer through this one quickly. So a couple of different changes. So one is this tiers of ownership. A lot of people that I've talked to on Zoom calls and just that have reached out in the space, they want to do roll-ups in specific industries, which is great. And we've worked on lots of those transactions. People that have done them in HVAC, in digital marketing, roofing. The challenge now is with this 2 full years of current ownership, you can't do M&A with 100% financing as quickly as you could before because now there's this new stipulation which didn't exist. And so I think, I candidly don't know, Chris, if the SBA has data that people that have done these acquisitions staggered in close proximity, if those default at higher rates. My assumption, and this is just me shooting from the hip, would be that they probably do because you're just more constrained from a time standpoint. But that's definitely an interesting one.
That's another one that I feel like most of my clients, when they were trying to buy again or they were trying to refi,
Yeah.
they could get it done in less than 2 years, but it was always really difficult, right? So
Right.
it seemed like there already was a lot of at least guardrails around this
Yeah.
before the change.
Yeah. Well, the other thing too, I think is it gives in like if you think about like organic growth versus M&A, it kind of makes you think when you're in the operator seat, what can you do to really grow and stabilize your current platform before buying another one? And if
Hmm.
you know that you have these 2 years that you have to wait, if it were me at least, and I just bought a business, I would be thinking about all the levers I could pull to really get things spinning with my current business before doing the next acquisition because you know that you have to wait the 2 years if you're doing SBA.
Hmm.
Okay, next slide here. Do you want to Kev go through this or do you want me to take it?
You could do this one. Yep.
Okay. So existing owner buyouts and partial change of ownership. So essentially, some of the guideline changes that have taken place have to do specifically with the change of ownership, which is most of what we're going to be covering here on this slide. So a couple of different things that have changed is remaining owners in the business. So remaining owner buys out another owner, ending at 100% ownership by the remaining group, or the company redeems the interest. The old 9-to-1 debt to worth requirement, which basically meant you can't have a balance sheet leverage at more than 90% with less than 10% equity if there's going to be a buyout. Some of that has basically gone away. And so now, and get back to this partial change of ownership. So one of the questions that was posed in the Q&A was on the seller rolling equity. So now basically an outsider, like a first-time business buyer, may only acquire less than 50% and can't be the largest direct or indirect owner unless it's done as an initial acquisition. So what that means basically, Chris, is say that you have Chris's manufacturing or Chris's HVAC, and I want to come in and have buy ownership in your company and be a majority shareholder. That unfortunately, before these guidelines went to place or will be going to place on October 1st, that's something that I've seen happen before where you could keep 10% ownership, you'd have to sign a 2-year personal guarantee, and then I would be coming as a majority shareholder. Now essentially that's not going to be possible. So the seller is going to effectively have to be business partners with you in pretty much an equal or comparable equity capacity. I think this is a pretty interesting one. What are your thoughts?
Yeah, I think it's another one that again the SBAs they don't want defaults, and so they're trying
Yeah.
to find ways to make changes that are going to reduce the likelihood of defaults and protect themselves. And ultimately, it makes some of it a bit harder for buyers to get deals done. And it's going to be easier for buyers that are more well capitalized
Right.
deals. So,
The way that I kind of look at it is if you're a seller that wants to take some chips off the table, economically speaking, but you don't want to fully sell,
mm,
it makes it where you have the ability to do that by having someone buy into your business. But it enables that like assuming that's a good marriage of the seller and the operator, which of course you never know how these things will go. It goes all different directions. The operator, the buyer that buys in after a couple of years, presumably speaking, they could go back to their bank and buy out the seller at that point in time, and then the seller
mm.
would be out, and their recourse would get wiped out. So I kind of see it from that perspective. I think I think it's gonna make it a lot more challenging now though for people that want to do the partial buyout deals because there are a lot less sellers out there in the market, if any, that want a personally guaranteed debt, unless the all the stars align.
Okay.
So going to the next slide here, Chris, this is gonna be your fire.
Yeah, so big change to the Q of E, and is now a mandatory requirement for deals that are over $3 million in purchase price. I'd say that's one thing. I think it's always makes sense to do a Q of E. Obviously, I'm a Q of E provider, but if you're buying a business over 3 million bucks, a Q of E is going to be a great way to help protect us. I think in general that's a good change. However, one of the big shifts around this is that the buyer is no longer the client of the QOB provider. The lender has to be the client. So that's a pretty big shift. And it's a big shift for a few reasons. One of them is that, and we're still trying to figure out exactly how this is going to play out. But like as a QOB provider, when I work with my clients, there's a lot of consulting that goes on along with that client around working capital and how we're talking about purchase price negotiations or purchase price asset allocation. There's lots more that goes in that's more consultative than just pulling out an EBITDA figure and throwing it at the client, which that seems like a little bit more what the lender's looking for here is they want a third party, a qualified professional to go through and validate what real earnings are and provide that to the bank. And then the bank has to use that in their DSCR calculation and for valuation of the business. So TBD exactly how some of this plays out with, do buyers still need to have their own accountant on their team in a different capacity, in a different scope than what they had previously because the lender's doing the Q of E? We'll see how all that
So
shakes
here's
out. And also,
so
yeah,
Chris, here's a question for you on that one. So I know when that guideline changed, like when the headline first came out on that point,
yeah,
there were a lot of providers that were very excited, right? Like lots of the big name ones on LinkedIn, Twitter. And then people like yourself read into this in more detail and they came to the realization of the paradigm shift where the intended user or the person ordering the report presumably is the bank versus the buyer. If you're a buyer and like you really care about financial due diligence, should you be asking the bank which providers are on their list, or like how do you think that's going to go from a dynamic standpoint?
yeah. I think that's important. But I think going back to like why did this change get made? I would imagine that again, there's default rates, and the SBA felt that a Q of E is going to help protect against that by finding issues with the financials, and it's going to kill more deals. But there's a reason that somebody there said they have to have the engagement with the lender.
Mm-hmm.
And it very well may be because there's some people out there that aren't qualified to be doing a Q of E and are shoving out maybe cheap reports that are just trying to get a deal done
Yeah.
versus finding out what the reality is. And I think that's part of the reason why this shift has been made, so that a lender can make that decision.
Yeah.
They're ultimately the ones holding the big bag, right? They're putting up the majority of the capital. So it does make sense in that way that if they're the one putting up most of the money, they should have some power and some decision making over who's actually qualified to
Yeah.
give a good analysis of the financials and what real EBITDA is.
So here's a contemporary question, Chris, and this is one I've gotten kind of asked multiple different ways, but by clients and prospects, is if I'm working on a deal now and I'm under LOI or I'm about to go under LOI,
Hmm.
and I don't want to wait until October 1st or whenever the new guidelines go into place. What is the expectation as far as you're aware, where if I engage a QV provider, whether it's your firm or someone else, and my SBA loan approval gets pulled after October 1st, how do I know if the bank will be able to use your QV report?
It's a great question. That's something I've been talking to lots of banks about to try and get understanding on how that's going to work. And I have yet to get a clear answer. I've gotten different answers from different banks, and some of them just don't know at all yet. So I think it's a little bit of wait and see. I would talk to your lender if you are getting close to a deal. It's probably a good idea to chat with your lender because it doesn't appear to be the way the guidelines are written. It doesn't appear to be written in a way where like assignment of a Q of E is going to be possible, or a reliance letter or anything like that. It
Yeah.
really seems like with the way the SOP is written, the agreement has to be from the outset between the lender and the QV provider. So I would guess that if you're not getting your loan number before October 1st, you're probably gonna have to pay for a second QV through the bank.
Right.
Is what I would guess. Yeah.
My biggest question with this, because as you know, all these different QVs cost different based on the firm, is what banks will be working with different providers, and then what those QVs are going to cost. And then
Mhm.
if you're the client or the buyer, is knowing that in the front end so that one, you can budget for it, but then two, kind of knowing like based on the reputation of said provider in the market, if they're more conservative or less conservative, if it makes sense to get some of your own confirmatory diligence to complement that as well.
Yeah, that's a great question. Kind of going back to what I said in the outset there's a lot of value. Like your deal team historically in business is like your lender, your lawyer, and your accountant. Those are kind of like the three main pillars of your deal team. There's other providers that may help you as well, but those are the big ones. And if you're no longer having a Q of E provider, you're not having an accountant, well, there's still probably things that an accountant are going to be able to help you with. On the
Yep.
tax side, around thinking about how you're going to negotiate working capital, make sure you're going to be in a good spot, even helping with projections and other aspects of your deal. So I do think that even if people are buying a business and they're not the one engaging the Q of E, it may still be helpful to have an accountant on board in a different scope, your own accountant on board in a different scope. Because we don't know
Yeah.
how that relationship is going to work. Like sometimes I'm providing a Q of E to a client and they're a first time buyer and they might not come from a finance background. And if I was just to throw the Q of E at them and there was no ability for me to really walk them through it and explain it, they're really not going to know much of what they're looking at. They might miss things that are pointed out in the report that a more keen eye would understand better. So I do think that there could be a great opportunity to still have an accountant on board for your own type of diligence on top of what the bank's doing.
Yep. No, completely makes sense. It's interesting times for sure. So flipping here to the next slide. So Chris, this one kind of goes hand in glove with the prior slide.
Yeah.
So I'll let you kind of take this one too. I guess the only point I have or comment I have, and this has kind of been historically how things have worked, is most banks or the vast majority of the banks in the SBA market will allow you to finance into the loan budget both your quality of earnings report costs as well as your legal costs. So the first bullet point here on the timing is essentially if you know, or sort of kind of bop around, if you know that you're going to be getting a QV and you know what the cost is going to be, you can include that in the budget in the use of funds. But
Mm.
Chris, feel free to kind of take the rest of the slide here.
Yeah. So a few things on the QV, like the SOP does say very specifically what needs to be included in the QV. I don't think there's anything super surprising there. Good quality earnings reports generally would have had those things anyway. But one of the big ones, proof of cash. That's where you're making sure that the activity in the bank account and the bank statements is matching up with the activity in the books. That should always be in a QOV, but it's written out in the requirements. A reconciliation to the tax returns is also something that's specifically listed. Any adjustments that are being made to the books, those have to be documented and supported with evidence. Analysis of the reliability of revenue and earnings to continue into the future. looking at things like contract changes or customer concentration, likeliness of the margins to sustain, things like that are going to be required to be analyzed in the QOV as well. And then ultimately the findings from that are going to go and be used by the bank for their calculations. And as you mentioned, this is for all deals over 3 million. So if it's under 3 million, technically the bank doesn't need to get a QOV. Buyers may still seek to order their own, but it's not required on deals over 3 million. And even though the bank is now the one that's engaging the QOV provider, the buyer is still going to be the one that ends up paying for it. And I believe that prices are probably still going to be pretty similar to what you're seeing on the market before, but TBD exactly how that shakes out.
The fact is, no one knows, right? It could be the same. You could end up getting pulled down to $5,000 before you know it, Chris.
We did
All
get
right,
we did get a few questions here that maybe, and I'll
Yeah.
get back to some of the other ones from earlier, but some specific to the QOV. One here, if you need to get your own second QOV, I'm assuming you could also get that still and get that counted as deal cost. You have to explain the SOP guidance around deal cost being applied into the equity injection in general. So I think what the question here is basically is before this change, if someone was engaging a QOV provider and they had paid for it pre-acquisition, that can be considered part of their down payment towards the entire deal cost, right? And so if they still spend some money on an accountant and some level of advisory diligence or even like a whole second QOV, will that still be counted towards total deal costs?
So my understanding, this is just from what I've seen before, is that second QV or like anything that you've paid for that's applicable to the transaction to the deal, as long as there's a line item for it in the loan budget, you could, if you've paid money towards it, you could count it towards the down payment, more or less.
Got it. That's great. And then one other question here. Couldn't lenders still order as extensive a QV as a buyer typically would? And couldn't the bank still clue in the buyer on the process, given the lender still order the QV for technically their own benefit? Yes, definitely. And I think that's part of the reason that they've made it so the lender has to be the one engaging the provider. So it seems to me like they trust the lender to maybe pick the provider more than they trust the buyer to pick the provider, which is I don't think that's a bad thought process in general, because some buyers don't know what they're looking for. It's a common question I get from prospects is, hey, Chris, I'm getting a QV quote from one guy and it's $5,000 and I got another one for $30,000. Like, what is the difference here? And if you're a first time buyer, you've never been through a QV process before, it can be really hard to figure out what the actual difference in scope is. I think that's why the SOP lays out exactly what that scope has to include. And they're trusting the bank to make that decision. What's a reputable firm that's going to be able to do a good job there.
What I suspect, I'm just kind of riffing here, but from like what I've seen before, Chris, back when I was a closer working at these banks, is like with business valuations or appraisals, the banks have a list of approved vendors that they'll go to. And my presumption here, assuming that these banks each have a handful of QV firms, is they'll probably solicit for bids. And then depending on the cost and the turnaround time, they might ask the buyer which one they want to go with. Like if there's a $5,000 delta or something.
Yeah.
But that's my hunch on how it will work. But I honestly don't know. So.
Yeah, and I'm also really curious. I think this is one of the questions we had in here is like once the QV provider is engaged, like what will that relationship be? Even though we're engaged with the lender, what, if any, relationship will there be with the buyer? Like, for example, we're doing seller interviews. There's a lot of good things that come out of those seller interviews. And sometimes buyers get a lot of value over attending those calls. Like, are they going to be allowed to attend those, or are they completely separated from the process?
Yeah.
I think it would probably be best for everyone involved to have a similar process to what already happens, where the buyer still gets that relationship and the seller on their side, they're still being able to talk to the QE provider, and it's a collaborative process. It's just an engagement with the lender. That's the way I hope it unfolds, but we'll see how it actually ends up breaking down.
Yeah, no, it's super interesting, honestly. I mean, this is like one of the biggest changes by far in the new guidelines. So I know we have a lot to still cover here, and I want to kind of hit on some of the big changes. So just give me a second. I'm just gonna see what. Okay, so we talk QV, down payment. Okay, so here's one of the biggest changes in the guidelines, but by far, Kev, bar none, is the new changes specific to the specifically where can a down payment come from for an SBA finance deal. So to kind of go back in time to, back when I started Pioneer back in May of 2022, and when Chris started Midwest CPA, I think early 23-ish, right? 2023, Chris?
Yeah,
A lot of these deals kept going back, since time. The structure in these self-funded search deals has been, business buyer either is coming up with the whole down payment on their own and there is no equity raise, or someone's buying a business, they're pulling together friends, family, people in their network, or they're going out to Sam Rosati's investor list, Ben Tigler's list, or these other places, and they're offering these investors a common equity step up and a preferred rate of return based on whatever current market clearing terms are. And so, historically speaking, up until these guideline changes are going into place on October 1st, there has not been a minimum of portion of the down payment that has to come from the searcher or the buyer. So the biggest change that's taking place effective 10/1 is if you're buying a business, half of the 10% down payment, which is not based just on the purchase price of the business, but it's based on the total project costs, half of that 10% has to come from you as the buyer. So if you're buying a $4 million business, let's say the purchase price of the business is $3.65 million, and then you have $350,000 of other stuff, most of which is working capital and the SBA guarantee fee. $400,000 is the equity injection or the requirement. Lock that down the middle. $200,000 of that has to come from you. And so what I think is going to be interesting here is what is the new avatar going to be of the first time acquirer? Because if you're buying a business that's $3 million plus or what have you, and you can't come up with 10% of that number, that's going to really thin out the pond of people that can buy these companies. And Chris, I'd be very interested to kind of get your perspective on what you think that's going to mean from a perspective of how many buyers are qualified to buy a business now.
Yeah, and I think it's going to shrink the buyer pool. I would be interested to go back on my list of closed deals from this year and just see how many would no longer qualify to buy a business. But I think it's a decent chunk. They're not going to be able to come up with that 5%, especially if they're doing a larger transaction and maybe they just like were working a corporate job previously. It could be pretty hard to come up with that 5% for some people. So again, kind of thins the herd a bit, and it's really pushing towards the world's a little bit easier for people that have the money to do the deals, and it's harder for people that are needing to raise equity and get a lot of debt in order to get the deals done.
So one of and this is just me kind of sprinkling my opinion here, so to kind of embellish on this, one of my concerns isn't solely the guideline change that half of the funds for the 10% down have to come from the buyer or the person signing the personal guarantee. My concern is on the restrictions now for investors that are putting in equity into these deals. So a lot of the folks, if you're raising money from someone that can write a $100,000 check, $250,000 check, or $500,000 check, that avatar of person has options for what they can invest in, right? Like they could be a limited partner in a lower middle market private equity fund. Potentially, they could be part of a real estate syndicate that's paying distributions. And they have other options available to them outside of just investing in ETA deals. And so the guideline change, or one of the guideline changes that is going into place, is on the investor equity. And this might be on this next slide here, so I'll just kind of shoot ahead. So on the investor equity that's going to now be part of these cap tables, if you're able to come up with half of the down payment yourself as cash and you're raising money from investors, while the SBA loan's outstanding, you can only pay the investor tax distributions. You can't give them profit distributions. You can't give them any type of pref payments. And so the folks that historically have been adept to investing in the space, that now very much changes the economic model because the avatar of people that's now going to want to invest in these deals are going to be kind of long-term buy and hold type people, but they're still going to want to know at what point capital is going to be returned. And so the question for the searcher or for the buyer is, does that now mean that terms will get worse where the equity step up is going to be more for the same $100,000 that you, Chris, are investing into a deal? You're going to want more of the cap table. What all is that going to entail? From a first principles standpoint, anytime liquidity shrinks in a market, the people that are providing the liquidity or the capital, that improves their terms in their economics. What are your thoughts on all of this?
Yeah, I think you nailed it. Like again, it's just making it more difficult to get the deals done, and the investors now, if their terms are being forced to be worse, then they're gonna either look for alternatives or are gonna want their terms elsewhere to be better, where they still can be better. They're gonna want their terms to be better. So to
Yeah.
offset the, like you said, the liquidity being worse for them.
One of the challenges too is let's just say hypothetically you have a $10 million fund or something around there because that's kind of the number that a lot of these equity investors in this space their funds are around. You have options for what you can invest in. It doesn't have to be SBA finance deals. It could be independent sponsor deals. It could be providing growth equity to an existing business owner or different things. And so the unfortunate thing that I think will happen as a byproduct of this is there's going to be a lack of capital from that avatar of person, and it's going to be more friends and family writing $25,000-$50,000 checks, where it's going to just take more time and more of a lift to pull those funds together. That's my speculation. That I'd be happy to be proven wrong. So okay, so this next slide kind of goes hand in glove with the prior slide. So this is talking about with funds coming from an investor for the down payment. So essentially, the part coming from the investor to get to the 10% down, in the circumstance that half of the 10% down is coming from the investor, those specific funds are governed by now only being able to have tax distributions during the whole period of the SBA loan, no pref, things of that nature. Any additional funds to capitalize a down payment in excess of getting to the 10% down, those funds can have the normal profit distributions and basically mostly the other stuff that they're used to be. And so in this illustrative example here, so if the equity injection or if the down payment to buy a business is 15% cash equity, which is over and above the 10% needed for the down payment, essentially the extra funds coming in from the investors, the extra $100,000, those funds could have profit distributions paid on them, but the tranche that's basically being used to get to the 10% down, that can only have tax distributions paid during the hold period of the SBA loan. And so this is now getting more complicated and more complex due to this guideline change. But we'll just kind of keep pushing ahead here.
Yeah, Matthias, do you want to? We got about
Yeah.
15 minutes left, so we got a bunch of
Yeah.
questions. Do you want to take a minute and just still field a few of these?
Yep. No, for sure.
All right, the first one we got here, there seems to be some confusion on refinance deals that were
Yeah.
financed based off amortizing. We haven't talked too much about this one. Or based off financing amortized over 25 years. These acquisitions that included real estate components over 51%.
Yep.
Per the new rules on non-real estate will be amortized over 10 years only, thereby not resulting in the 10% payment requirements on refis.
We're
Able to
talking
touch on
about
that at all, and how the changes have occurred around real estate and being able to amortize over the longer period of time? Because the old rule used to be able to, if you used to be able to amortize over 25 years if there was enough real estate in the deal, right?
Yeah, I'm just reading the question again. Per the new rules, non-real estate will be amortized over 10 years, only thereby not resulting in a 10%. So, so Manish, I guess to kind of hit on the question, I'm just trying to unweave it here. So with the new guidelines from a high level, if you're buying, if you're buying just a business, asset purchase or stock purchase without any commercial real estate, the amortization is only going to be 10 years. If you're buying a business with commercial real estate, the old rule essentially was if at least 51% of this whole project cost or use of funds was for building purchase based on the lesser of appraised value or purchase price, by default, essentially, you'd get 25 years for the amortization. So now the way it's going to work is it's going to be a weighted average formula, irrespective or regardless of the percentage of the use of funds for the building, where the formula now is 10 years times the non-real estate use of funds. So basically, looking at total use of funds, 10 years.
Go to slide 21 too. I think you have a good example of this.
Yeah. So we'll just kind of shoot ahead here. So slide 20, second here, slide 21. I think that this is the one here, right? Buying a business with real estate. So essentially the way it works is if you're buying a business with real estate, you look at the weighted average of uses of funds, and based on how the math breaks down, that impacts what the amortization is going to be. Old guidelines in place until October 1, if real estate's 51% or more, you get 25-year loan. New guidelines is it's going to be a weighted average formula between 10 years and 25 years. And so the implication there basically is that for the same deal with real estate, like your debt service is going to be worse or it's going to be higher due to the fact you can't get as long of a term of a loan. I don't know if that, and Manish, we can talk offline too, because I know we talk periodically. Chris, what's the next question to be good to cover here?
Next question, what are the liquidity tests referenced in the expansion or buyout categories?
Yeah, so on the liquidity test, and I saw that question, Asa, give me a second here. So from a high level standpoint, so business expansion, so the baseline requirement is that you have to have 10% unless you can get the lender to waive it. So like in the current guidelines before October 1st, by default, the 10% down is waived. Now the lender has to document in their credit memo why you don't need to have the 10% down. The other thing is basically you can't have a negative net worth. So based on the balance sheet of the business owner or the applicant, it can't show a negative net worth for the last fiscal year. And then the other thing is you can't have any permanent working capital financed into the expansion if you want to do 100% financing. Chris, let's just kind of hammer through the last couple slides here, and I'll send these slides to everyone here on the call so we'll kind of go through towards the very end here. So the blended term and amortization, that's one of the biggest changes to the guidelines. Essentially, if you want to buy a business with the building, you no longer can get a 25-year loan if the building comprises at least 51% of the uses of funds. This personally, I'm not a fan of this change because it is going to impact debt coverage relative to what it was before. And so essentially, if you're buying a business with a building, you want to make sure that you're using a weighted average formula. For anyone here on this call, I do have a cash flow model that I can share. So if you reach out to me via email and my contacts at the end of the slide, I can send that to you so that you can kind of work through deals and make sure that the numbers ultimately work. And so this is kind of talking about the 51% rule when you're buying a business with commercial real estate involved. So the last couple slides here, just before we get to the Q&A at the end. So with the old SBA guidelines, the way it worked is the SBA 7A loan proceeds, so the 7A loan being the type of loan you'd use to buy a business, could not exceed the valuation of the company that you're buying, which would be determined based on a third-party business valuation. And then any difference you could bridge with equity and seller financing. And so now basically there's a cap on the total debt you can use to buy a business where it's not just the SBA loan. So the total debt that you're using to buy a business, whether it's bank financing, so SBA 7A loan, and or seller's note not on standby, is capped at the valuation of the business. So the my thought process here, and Chris, I'd be curious to get yours, is the SBA basically doesn't want buyers overpaying for businesses, and they are taking kind of a more paternalistic stance here where they're making it where it's not just senior leverage that's capped at the valuation, but also the subordinate seller leverage too, to avoid kind of hampering the balance sheet of the buyer going into the business.
Yeah, they're forcing buyers to be a little more responsible about the debt they're willing to take on, and the way they're able to go about buying a business, which will make it a little bit harder. But I think some of these changes will ultimately be good, because I think there
Yeah.
were some people that were taking some irresponsible risks. So
Yep. I'm just gonna field a question here from Hereford Johnson in the Q&A. So the question is, for the unlimited sources, can you borrow a personal loan from friends and family as the 5%? So Hereford, I was actually looking at this last night because I have a prospect that had that same question. And my understanding is that you can, as long as you can repay the personal loan outside of the cash flow from the business that you're purchasing. But that's going to be something that's going to be at the discretion of the bank, because using the same analog as like a home equity line of credit, the SBA guidelines allow business buyers to use a home equity line for part of the down payment for the business that they're acquiring if you can make repayment on it from outside the cash flow of the company. So if you have stock and bond income, rental property income, something else. But some banks don't like equity that's not truly cash. And it's just ultimately comes down to the specific lender. Second point here on this slide, as far as changes go, is interesting. So on the seller consulting, changing from only allowing a seller to stay on for 1 year to 2, from your perspective, Chris, what do you think the implications will be there?
I like that one. I don't really understand why, like, a seller transition is super important to, like, a good seller transition is like one of the biggest reasons that a deal will go well.
Yeah.
If you have a good seller and they want you to succeed, they want the business to succeed, and they want to transfer the knowledge to you, that could be invaluable in the process of buying a business. And I
Yeah.
think extending from 1 year to 2
Yep.
makes a ton of sense. And I mean, to be honest, like, I've known people that have done that regardless anyway. Like,
Right.
it's kind of hard, like, after the deal's been going for a year, like, you got questions
Yeah.
from the seller, right? Like, I think it's been a difficult one probably to enforce. Like, I know people that have still asked the questions
Have to
again.
be careful what you say on this webinar, Chris. It's all being recorded.
Well, I didn't do it, but I've seen people do it. So
Right. Right.
I think they're maybe just listening it, and I think it makes a lot of sense. Like, keeping this up,
Yeah.
to have a good transition is going to increase the likelihood that the business does well.
Yeah. So on the third one here with the seller note refinance, I think this one's kind of a toss up as far as how I look at it. So essentially, the old guideline was if you had a seller's note with current payments for 2 years, you could go back to the SBA bank to refinance it out. Now you need to have 3 years of current payments. I think the implication here is going to be from a deal structuring standpoint, there will be less buyers that might have seller's notes ballooning earlier in the process, because I've seen folks that have come to me with letters of intent where they might have a balloon at the end of year 2 or year 3 in the seller's note. And unfortunately, if you buy a business, you experience the J curve and financial performance goes down, even if you are technically allowed to refinance after 2 years, you're not going to be in a position to do so. And so this will hopefully and optimistically, when buyers are structuring deals, they're going to be thinking about, is the seller's note just straight amortizing, and or is there a balloon? And if there's a balloon, maybe it's around like year 5 versus year 3. So
Mhm.
I'm just going to skip over this last kind of part here and this slide here. So we're going to jump ahead to the very end and kind of go back to Q&A. And for anyone that has questions as well that we don't get to, feel free to shoot an email to either myself and or Chris. I'm a lot better probably at email responses than DMs on Twitter or LinkedIn. But Chris, if you want to go back to kind of going through the Q&A and fielding the reading off the questions.
Sounds good. Yeah, but we got time for maybe like three more. So I'll run through a couple here that stick out to me. We have one here from Ryan. I'm confused on how or as to how deal costs are being routed. Are deal costs that are being applied to the equity injection being routed considered part of unlimited sources? Do you know answer that with this?
So I think Ryan, if you're paying for the deal costs, so like in this circumstance, let's say you get a quality of earnings report before the process starts for financing. If you've paid for that QV report with your own personal cash or personal funds, I think that will count towards your contribution for the unlimited sources and basically like your net personal contribution towards the deal. So like if the down payment on the deal is $200,000 and let's say you've paid 15,000 towards the QV, and of that down payment requirement, let's say that 50% is your part and then 50% is investors, that the QV that you've paid for, my understanding is it would count towards your half of the requisite amount. That's my understanding at least.
Let's see. Next one here. Are there any changes to forgivable seller note guidelines?
Yeah, so the change that I kind of caught when I was reading through the SBA guidelines is that with the new change to the guidelines, if a seller's note is forgiven and if there was like any type of buyer rebate, that needs to be used to pay down the principal balance of the SBA loan. That was kind of what jumped out when I was putting this deck together.
Awesome. All right. Well, I want to be respectful of everyone's time. We're at time here, but maybe just last question. I think that comes up in Q&A. I think it's a good one to end on.
Yeah.
Overall, all these changes, do you think these are, do you think these are ultimately good for buyers and the ETA community in general, or neutral, or negative, positive? What are your kind of passing thoughts on these changes, Last?
So I think it depends on the buyer. So like if you're a very well capitalized buyer where you're not needing investor equity, I think for you this makes no difference and or candidly speaking just reduces the amount of competition that you have on the buy side. If you're typical like business buyer that's planning to raise investor equity and wants to offer normal investor terms, preserve post-close liquidity, and not deplete a lot of your personal resources, and you're not super well capitalized, I think it's going to be a net negative, unfortunately, because now it's going to make it harder for you as a buyer to buy the same size business that you wanted to. Because if you want to buy that same size company, there's a limitation on how much of the down payment needs to come from you. And for any investor equity dollars that you're raising, there are now going to be stipulations on provisions with the repayment of those dollars due to only being able to do the tax distributions versus the normal profit distributions. So I think for the buyers coming out of corporate America that don't have as much capital in their personal balance sheet, it's a negative. I think for the more mid and later career person, it's going to be a net neutral. That's my thought.
Yeah. Yeah. I think my kind of closing thought is that ultimately, I think the mindset behind these changes is to protect buyers and make sure they're doing deals that they're in a good spot to do and aren't going to have run into issues and default. I think some of the changes I think hit the mark and did that properly. I think others maybe I don't totally agree with, but I think net a lot of the changes are good, although it may make deals a lot harder to do if you are not well capitalized. So
Yeah. Yep.
awesome.
And
Well,
for anyone that's interested in kept talking further with either myself or Chris, I'm gonna send a copy of the deck to everyone that registered, so you'll get the full PowerPoint. And our email contact is at the very end of it. I think on the last slide or second last slide.
awesome. Well, this is great, Matthias. Thanks everyone for coming. We appreciate your time and have a great rest of your Wednesday.
Awesome. Yep. Thanks everyone that joined here. Have a good rest of the day. Take care.